3 years ago, one company supplied 95% of China's AI accelerators. By mid-2026, its share of new shipments was near zero. Nvidia's presence didn't fade. It collapsed. Revenue that flowed to California for a decade now stays in Shenzhen, Beijing, and Hefei. Not because demand disappeared, demand exploded, the supply structure changed permanently. What filled the vacuum was not one company, it was an industry. Huawei Ascend, Cambricon, More Threads, Biren, Iluvatar. Some have working chips in production data centers, some have investor presentations and tape-out schedules. The velocity is staggering. Huawei's AI chip revenue heading toward $12 billion in 2026. Cambricon, revenue up 453%, first annual profit after 9 years of losses. More Threads, revenue up 243%. Biren, revenue up 207%. But last episode we saw a pattern. The memory gate. CXMT filled the commodity DRAM gap the incumbents left, growing faster than anyone expected. But growing in the space the keyholders chose to leave. Speed is impressive. Speed and position are not the same thing. This episode, the compute gate. Same structure, different chain. This time, the gate is not just about what you can design. It's about whether you can get it built. 3 tiers. The lines between them matter more than the benchmarks. Tier 1, Huawei. The only company with a full-stack AI chip ecosystem. Ascend 950 PR entered mass production in March 2026, exceeding the H20, the last chip widely available to Chinese buyers. At 1/4 the price, 812,000 Ascend chips shipped in 2025. China market share approaching 50%. Bernstein projects Nvidia's China share falling to roughly 8%. But here is what matters. Huawei doesn't just sell chips, it controls the ecosystem. Ken is its software stack. Mindspore is its AI framework. From chip design to cluster deployment, Huawei covers the full stack. The closest thing to Nvidia's CUDA in China, still years behind in developer maturity, but the only domestic alternative that runs from silicon to application. Tier 2, Cambricon. Revenue up 453% in 2025. First annual profit, RMB 2.059 billion, after 9 consecutive years of losses. Market cap over RMB 1 trillion, first company on the star market to reach that milestone. But look at the customer base. One client widely reported as ByteDance contributed roughly 2/3 of total orders. Cambricon's chips are designed for inference. The demand is real. But the concentration is real too. Tier 3, the challengers. More Threads, Biren, Iluvatar, all growing, all shipping products, none at Huawei's or Cambricon's scale. More Threads, revenue up 243%, first quarterly profit but subsidy supported, core business still losing money. Biren, revenue up 207%, solid gross margins but still net loss. Iluvatar, ByteDance in talks to purchase 50,000 inference chips, nearly equaling its entire 2025 shipment volume. The velocity across all tiers is real. But the question is not whether these companies can grow, it's whether they can get manufactured, and that question leads to the gate. Before the gate, understand why everyone is racing. Inference accounts for more than 2/3 of all AI compute demand in 2026, growing faster than training. China's daily token consumption exceeded 140 trillion by March 2026, a 1,000-fold increase from early 2024. DeepSeek's V4, released in April 2026, was adapted by 8 domestic chip makers on launch day, day 0. Every internet company in China needs inference capacity. None of them can rely on a single supplier anymore. ByteDance allocated a RMB 45 billion domestic hardware procurement budget, split between Huawei and Cambricon, and qualifying secondary suppliers as backups. Not choosing one winner, hedging. Demand is not the bottleneck, supply is. And the signal from the other side. DeepSeek, the model company that made domestic chips viable at scale, is now exploring its own inference chips, still early. But the direction is clear. Even the companies that buy these chips are trying to reduce their dependence on the chip makers. The gate is visible from both sides. Now the gate. Every AI chip designed in China faces the same question. Who will manufacture it? The answer converges on a single point. SMIC's N+2 production line, the only operational advanced manufacturing process in China capable of mass-producing AI chips. One line, one company, every AI chip designer is a customer. SMIC's N+2 is expanding. But even at full ramp, domestic AI chip output covers roughly 60% of total demand. The rest cannot be manufactured. Not this year, likely not next year either. 3 structural locks keep capacity below demand. Lock 1, manufacturing speed. Without the most advanced lithography equipment, each wafer takes 2 to 3 times longer than at a comparable international foundry. The speed ceiling is set by the tools available, not by ambition. Lock 2, cost. Per wafer manufacturing cost runs 40% to 50% higher than international benchmarks. SMIC's full-year revenue is roughly 1/13 of TSMC's. Expanding capacity compresses margins further with each incremental wafer. Lock 3, yield. The advanced process yield recently crossed the break-even threshold. TSMC's comparable node operates at substantially higher yield. Low yield means capacity numbers look larger on paper than in reality. 3 locks, each independently limiting. Together they create a structural ceiling that will not move for 3 to 5 years. SMIC CEO Zhao Haijun described a siphon effect on a recent earnings call. AI demand absorbing the foundry's premium advanced capacity. His assessment, the capacity squeeze has only just begun. The deficit will widen before it narrows. Now the allocation question. When supply is 60% of demand, who gets manufactured? Huawei, roughly 40–45% of SMIC's N+2 capacity, locked in a long-term supply agreement spanning multiple years. High-silicon engineers have been embedded within SMIC's production facilities for 3 years. Their diagnostic and testing data contributed a majority of the foundry's advanced process yield improvements. Huawei is not just a customer, it is an operational partner. When the foundry's yield improved, Huawei's chips got better. When Huawei's chips got better, the foundry's utilization rose. A shared supply chain destiny. Cambricon, roughly 9–11% of N+2 capacity, plus 30,000 wafers per month at its Beijing joint venture facilities. Cambricon's position is supported by regional state capital. Every wafer carries the weight of local government investment. Everyone else, fighting for the remainder. Hygon, because its CPUs underpin enterprise computing. Alibaba's T-head with 5% to 8% of residual capacity. Biren and more threads at the absolute margins. Not because their designs are inferior, because they arrived at a table where every seat was already taken. The combined annual shipment for the second-tier designers, roughly 258,000 units. Huawei alone, 812,000, more than 3 to 1. This is the compute gate, not a technology barrier. A manufacturing capacity allocation barrier. You can design the best inference chip in the world. If you cannot get it manufactured at scale, your design is a blueprint, not a product. 3 roles in the compute chain. The difference between them is not chip performance. It is where you stand relative to the gate. The strongest structural position, Huawei. Today, it holds the most favorable position in the compute chain, not because its chips are the best, because its manufacturing partnership with SMIC gives it priority allocation. Not because its software is the most mature, because it is the only domestic stack that runs from silicon to application. That position is structural today. But positions change. DeepSeek 5.4 was optimized for Ascend natively. That is a meaningful turn. When a leading model company optimizes natively for your hardware, the software gap narrows. It does not close. The dependent winner, Cambricon. Real chips, real customers, real profit, but roughly 2/3 of revenue from one client. Its manufacturing allocation depends on regional government capital, not operational indispensability. If ByteDance develops its own inference chip, Reuters reports it is already exploring that path. Cambricon's revenue base faces structural risk. Velocity supported by customer concentration and capacity dependence is not the same as holding the gate. The capacity marginal, more threads, Biren, Iluvatar. Growing fast, winning contracts. But manufacturing at the margins of allocation. When SMIC's capacity tightens, the marginal players feel it first. Their software stacks are CUDA compatible, but not CUDA equivalent. They lower migration cost, they do not create ecosystem gravity, growth is real, position is fragile. And the second gate, software. CUDA has been built over 20 years, 4 million developers, global default. The software mode is deeper than the silicon mode. Domestic alternatives are closing the gap. But closing a gap and holding the ground are different things. Two gates. Manufacturing capacity determines whether your chip exists. Software ecosystem determines whether anyone uses it. Neither is solved by a better benchmark. Nvidia went from 95% to near zero in China's AI chip market. Huawei filled the gap. Cambricon proved inference chips can be profitable. The challenger tier is real. The velocity is not in doubt. But the compute gate is not about who designs the best chip. It's about who gets manufactured. SMIC's N+2 line supply covers roughly 60% of demand. Huawei holds roughly 40–45% through a long-term supply agreement. The rest fight for the remainder. The difference between them is where they sit in the manufacturing queue. The software gate compounds it. CUDA's 20-year advantage doesn't disappear because the hardware is no longer available. It waits.
3 rows, the strongest structural position, one dependent winner with real velocity but fragile foundations, a cluster of challengers growing fast at the margins. Chips ship, gates endure. Next episode, we move from the brain to the body. Inference chips are the brain, but AI is leaving the data center. Humanoid robots are entering mass production. Building the body at scale has its own gate. Same structure, different hardware. See you then.